would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and that means I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. It's an interesting one today. We'll see. There's a couple of different little news nuggets I think we might want to pass around and sample. There's a big one, and it's being 99.9% pushed out there as good news, and I'm going to tell you why it's not good news, because that's the way things seem to roll here recently. We'll see if you agree with me or not. Absolutely, you can have a different opinion, but I think once we sort of explore it, it'll make sense that it's not really horribly good news. If you'd like to get in touch with me, feel free to head on over to the website at therebelbroker.com. Click the contact button to contact me. Click the store button to go to the store. That's where the Amazon store is. You can buy any real estate related books. You can any of the things various items that are not necessarily real estate related, but it's a great way for you to purchase things that you would have gotten anyway, but then also support the show. So thank you for taking part in that. And then, of course, big red button, top of the webpage, take the survey to support the show. Use the same email address both times you're asked, answer a handful of questions, and you're helping the show, but you're also putting yourself in the drawing for a $50 gift card to Amazon. So it's a win-win for everybody. We'll be doing the another drawing next month in February. And so far, we've handed out $200. And congratulations to the 4 folks who have won over the last 4 months. And congratulations to the folks who won the drawing for the Francis Greenberger hardback autographed copy of Risk Game. Those will probably go out in the mail on Friday, so you can expect to see them in your mailbox sometime next week. Okay. Stuff like this is frustrating. You know, this is the news that came out today is one of those things where it really continues to perpetuate a couple of dumb things. But let's go ahead and jump in, because 99% of the folks out there that are going to report this, the headlines are all going to celebrate this. Housing industry welcomes FHA mortgage insurance premium cut. Positive reaction from across the industry. That's the headline from Housing Wire. And if you do a Google search on this, you're going to find just about everybody is singing the praises of this move. We're going to analyze it a little bit. We're going to think our way through this one, folks. So it's not as simple as it sounds, and it telegraphs a not good thing. And when we mix it with everything else we already know about what's going on with subprime borrowers, and we're there, folks, we can now officially, I think, use this term. We've been sort of avoiding using it because really it was the term that was used last time around. And I've made the argument for quite a while now that we've really resurrected the subprime lending, but we've just done it in another way. Instead of ridiculously ignoring those things that measure whether or not someone has good credit or is a good credit risk, we're simply tweaking the things that measure whether or not you're a good credit risk so that more folks have accessibility to credit. And that's not me interpreting it. All these things they've done in terms of screwing with how credit ratings are calculated, all these other things, the specific goal, the stated goal was to make funds more accessible to a larger number of people, which is a inartful way of saying to folks who would normally not qualify for a loan. Housing Wire continues on to say, this is how their article goes. I don't think we need to read the whole thing. I will, of course, include a link to this article and several others on the subject. And the one article you'll find out on the internet that actually doesn't have good things to say about that, which is, of course, from our good folks over at Zero Hedge. So you can read that one and see what you think about that. But this article states, the Federal Housing Administration surprised some in the housing industry on Monday by reversing course and announcing that it plans to cut its annual mortgage insurance premiums less than 2 months after saying there were no plans for further cuts. According to the FHA, quote, most new mortgages with a closing or disbursement date on or after January 27th, 2017 will see a 25 basis point cut to the annual mortgage premiums. That's 0.25% to you and me. A basis point is just put a 0.25 at the front of that, and that's what it is in actual interest terms. In its announcement, the FHA said the premium cut will lower the cost of housing and significantly expand mortgage credit availability, sentiments that the housing industry appears to agree with. Throughout the housing industry, reactions to the FHA's announcement varied from welcoming the cuts to wondering why it took the FHA so long to make the move. And of course, everybody who has a vested interest in there being more buyers is giddy over this one. Now, remember, we've talked about this one before. This is not hard math. The solution to our problem is not more buyers. So let's attack this move from that basis. Let's not even worry about all the other horrible little things that are hiding in the details of this. You are not, in fact, not only are you not solving the problem, you are making the problem worse. And this is exactly what we did last time that screwed us up so horribly. We talked about this a little bit yesterday, priming the pump with bad loans. That's exactly what this action does. It primes the pump. And once we reach enough folks out there who have borrowed under these kinds of circumstances, if the market goes down, we get a repeat of 2006, 2007. No question about it. It's not an unknown. We've all lived through it and we've seen it. But let's really look at it from just the standpoint of solving a problem. Pretend you're someone who believes that people should make decisions like this to make it possible for folks to borrow more money, that lending to subprime folks is a good thing. Okay, let's approach it from that. What will this actually do? It will create more buyers and therefore artificially increase the demand for the existing inventory of homes. Since we are not seeing a dramatic increase in the inventory of homes, we've seen an increase in the number of apartments for rent because that's where the majority of the growth has occurred. What does that equal? Well, that means that you increase the number of buyers. So that means that for every home that goes on the market, instead of there being 2 people who want to buy it, now there's 3 or 4 or 5. Well, when you have a limited source of a thing and more people want it, what does that end up producing? An increase in prices of homes. So let's go down the wonderful list of ways we're quote unquote helping these buyers. So first, we're ignoring some pretty strong, reasonable standards of lending. We're saying, despite the fact your credit rating doesn't really indicate that you can handle this level of debt, we're going to go ahead and give it to you. That's not helping someone. We can have a debate about that. I'm sure there's some people out there who disagree with me. But you're not helping someone by saddling them with more debt than they can handle. Next, you're creating a scenario where these folks are going to have to borrow the maximum they can. Why? Because they're going to have to bid against other buyers to buy the homes that are available. Because remember, we have limited inventory, but all the actions that are being taken are designed to increase the number of buyers. Now, of course, who's going to love that? The Mortgage Bankers Association, right? Because they get to loan more money and theoretically make more money off of that loan. National Association of Realtors. Well, if there's more buyers, there need to be more agents, right? So that means more people paying their dues. The National Association of Home Builders is going to love that, right? Because that means that when they build a house, they'll end up selling it for more. So, of course, all the folks with a vested interest are out here to sing the praises of this one. But the net result is buyers will end up paying more and as a result, borrowing more to purchase these homes. So it's going to artificially increase the price of homes for buyers. Okay, so where does that leave us? Well, that leaves us with a whole lot of people who have bid up homes to the point where a drop isn't an unreasonable thing. If you get that kind of a frenzy going on, that eventually can feed into a drop just like we saw in 2006. So not only are we facilitating folks who probably shouldn't be borrowing these sums of money, we're facilitating that. Then by our actions, we're artificially increasing what they're likely to pay for the home they're going to purchase. And through that, we're creating a marketplace that is less stable to sustain their investment in that property, and therefore to service their loan. Remember, these are folks who only have 3.5% put down on these properties. That means as soon as a house drops in value by 4%, they owe more than the home is worth. Now that should scare anyone, because when you see a system being artificially manipulated in this way through these sorts of regulatory type moves, the volatility of prices within a marketplace tends to get more dramatic. That's what we saw in 2006. And as soon as things start to go down, as soon as we start to see a challenge in terms of the marketplace, and we don't know what it will be, right? The real estate world was sort of at the epicenter of it last time. It could be again, but as soon as we see situations where folks realize they currently owe tens of thousands of dollars more on a home than it's worth, more than they could sell it for, that's going to be that first indicator to us or to them to start to take actions that we saw last time. People who simply walk away from the debt. They just decide that that's not something they can sustain. And with there being only a 3.5% skin in the game on the part of these folks, that could create a huge problem. Okay. Let's look at this now from another angle. This stuff that is going to cost them less is called insurance. It's called mortgage insurance premiums. Okay. Well, what does it insure against? Well, it insures against default. It's designed so that when there are defaults from other people, when people go bankrupt or people get foreclosed on, whatever happens that gets these folks to stop making their mortgage payments, this mortgage insurance is what's supposed to be the funds from which the system draws to deal with that. Okay. Well, what happened last time? When we had this big downturn last time, why was there such a big deal since we had mortgage insurance? Well, because we discovered there wasn't enough money in the mortgage insurance program to actually take care of the problem. So we increased the premiums because we wanted to be smart. We wanted to say, you know what? We need to be a little bit more realistic about what we're doing here. We're facilitating a dicey money situation, and we need to make sure that the next time a bad thing happens, we need to have the funds available in this insurance scheme to handle the potential downside. Now, this isn't the first time. This is the second time in 2 years that they've reduced this mortgage insurance. But let's be real clear. The reason why these rates were increased in the first place a few years back was because we learned a lesson. I'm sorry, but it just reminds me a little bit too much of the kid who touches the burner on the stovetop and pulls that hand away with that burnt hand. And then once his hand heals, it's as if he thinks to himself, you know what? Well, maybe it wasn't as hot as I thought it was, and I should touch it again. That's the scenario we're in. We are refusing to learn from past lessons this market has taught us. Now, we're going to go ahead and continue to look at this subject. It's frustrating on so many different levels. It's almost mind-numbing. But we're going to take a quick break right now. We'll be right back right after this.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. Great news, everyone. FHA has slashed mortgage insurance premiums. Second time in the last couple of years. We've been talking about it. We took it at first from just the idea that encouraging more borrowing of FHA funds is the opposite of a solution to our current problem. Encouraging more first-time buyers, facilitating more subprime buyers. And let's be very honest, what this does is facilitate subprime borrowing. Okay? So we are absolutely aiming this financial gun at the people least able to deal with any potential problems that happen in the marketplace. It blows me away. I just don't get it. So as I was saying before the break, well, why do these premiums exist? Why are they there at all? Well, they're there as a backstop for when bad things happen. And the lesson, as I mentioned before, that we learned last time was we didn't have enough money as a result of those premiums. The premiums that had been paid over the years were not enough to take on the downturn that hit us. So correctly, those premiums were increased in order to make sure that you could have a robust program to deal with a downturn. Now, of course, I'm not quite sure how people forget this, since it happened not that long ago. But distance makes the pain of the whole thing, I guess, seem a lot less relevant. Or maybe it's for political points. Maybe it's to pander to one group or another. I don't really care. All I can tell you is that it's not a good thing. Because I'll be honest with you, if I try to put myself in the mindset of where I was in, say, 2004 and 2005 and looking forward at the marketplace, and I sort of tick off a list in my head of all the things that are good and bad about the real estate market. And then I flash forward to today and tick off all the things that are good and bad about the real estate market today. We were in a much better position back then to potentially weather a downturn than we are today. The employment situation was better. The types of jobs that people had were better able to support someone who was in debt with relating to a mortgage. The real estate markets themselves were in better shape. Granted, the lending practices were absolutely moronic, but a lot of the underpinnings that related to our real estate market were very, very strong. And other peripheral things that feed into the real estate market were strong. Today, not so much. I would say that we have a far more delicate situation today than we did then, which just increases the probability that some individual bad thing could potentially tip all of this stuff over. And moves like this are simply facilitating a scenario where we're going to be less likely to deal with it. I was unhappy when we reduced these premiums the last time, which was a couple of years ago. I didn't think it was a smart move. I don't think it's a smart move now. And it's clearly the only reason is to create more subprime borrowers. And again, stated purpose. That's what's crazy is I'm saying this and it's not even a conspiracy theory or some sort of crazy nut job tinfoil hat theory. That's why they're doing it. That's the stated reason. They want to facilitate more first-time home buyers and disadvantaged borrowers. So at this rate, we are again repriming that pump as fast as we can. This is the loan of choice. This is what a lot of folks are using to make their purchases. And so we are simply creating a ton of folks who are already, I think, at a higher risk for difficulty because of the type of loan that they're using. And because of the effect that creating more buyers has on the market creates a higher risk because they're paying more for these homes. And since they have so little skin in the game in terms of amount they're putting down, the probability of a downturn, I think, is increased by that. So it's not a good thing. The solutions we've talked about in the past need to be focused on the supply side, not the demand side. Demand side does not have at least not in my marketplace. Maybe some of you are in some markets where there is tons and tons of inventory and no buyers. I have no idea where that market is. Running down my head of areas where there's far more supply than there is demand, I'm having trouble thinking of one. So I'm not real sure why we have this sense of urgency. Maybe it's because it's a feel-good thing. Now, of course, as I mentioned before, the usual suspects are coming out touting how wonderful this is. One quote here is, the program allows borrowers to get a mortgage with a down payment of as little as 3.5% and a credit score of as low as 580 on a scale of 300 to 850. Now, remember, that credit score is the one we've talked about before on this show, where now they are including things within the credit score that have nothing to do with your credit, like your water bill or your phone bill or the power bill. None of those things actually have anything to do with your credit. I'm not real. And the only reason those things are being added, and this was the exact reason given, was because they wanted to give subprime borrowers a higher credit score. So you've simply artificially created higher credit scores not based on actual credit worthiness. We did the exact same thing leading up to that 2006-2007 crash, but all we did was simply say, well, you know what, we'll just go ahead and do loans to these folks with really low credit scores. So the next time around, they can say, wow, we don't know what happened. We lent this money to people with these credit scores that we've historically had good luck with, and suddenly everything's different. Who'd have thunk it, right? Well, the reality is that they changed it. They moved the goalposts on this one. And who knows if they'll use that as their excuse the next time this happens, but they're absolutely setting the stage for another hit. So let's not even pretend. Let's try to take a positive outlook here. Even under the most optimistic scenarios, they are setting the stage for something to eventually happen that is bad. Now, maybe they're hoping that they get all these borrowers in there soon enough and they're making payments long enough and the prices go up enough that when inventory does finally meet demand and the inevitable stabilization or decrease in prices occurs, it won't be by enough to put these folks underwater. Now, remember, in a previous show, and I think we brought this up yesterday, most of the pundits are saying that we'll start to see inventory matching demand by about 2020. Well, that's only 3 years away now. And by then we will have primed the pump quite a bit, I think, with these types of folks. And it really just depends on how much prices go down. Now, if they overbuild, that could be an issue. One of the big problems last time was there was an awful lot of overbuild with all of the dramatic increases in prices. Builders absolutely did build an awful lot of houses. But we're creating the same scenario that by artificially screwing with this stuff, this is what happens whenever you think you're smarter than the invisible hand of a marketplace. Whenever guys and gals start to get involved, because really only things can run correctly if someone's managing it. The unintended consequence is you create a scenario where folks see prices going up. And when you see prices going up, what happens? Well, if you're someone who can provide that thing that folks are paying more and more and more for, well, you build more of them. Now, of course, you don't want to overbuild and screw yourself, but every other builder out there in the marketplace is thinking the same thing. And so it becomes less about worrying about whether or not they overbuild and more about taking advantage of a market where prices are escalated while you can than it is about anything else. So I think we're setting a stage. We're setting a familiar and unpleasant stage, and we should all be a little bit worried about that. It's going to be interesting to sort of see how this course plots itself. Let's see what some wisdom from William Brown, president of the National Association of Realtors, what he shared. Quote, dropping mortgage insurance premiums today will mean a whole lot more responsible borrowers are suddenly eligible to purchase a home through FHA. Yeah, it's kind of really not what that means. There's no implication of responsibility. In fact, the way in which this is being managed actually specifically implies that these folks may not have the level of responsibility that we're hoping for. If these kinds of costs are what's really holding these people back, that it definitely indicates a cash flow problem. Anyway, the folks here from Zero Hedge have a few interesting words to share. They're as pessimistic as I am on this one. Quote, we vaguely remember something like this happening about 8 years ago, and while we'll have to check our files, our recollection is that it didn't work out all that nicely. Of course, the move was intended to offset the recent 60 BPS rise in the average 30-year mortgage rates because we simply can't sit idly by while markets attempt to actually work. The private mortgage insurers who have to compete with federally subsidized rates shed about 5% of their market cap on the news. Meanwhile, at least one congressman, Representative Jeb Hensarling of Texas, noted to Bloomberg that the Obama administration's last-minute parting gift to the U.S. taxpayer put them at greater risk of footing the bill for yet another bailout. And that, my friends, that's the payoff. What I'm most annoyed with is the reality that I'm not sure how many people have forgotten, but think back. When all of this was going on, when everything was going into foreclosure, all of these FHA properties were being foreclosed on, all of the stock was being soaked up. We had billions and billions of dollars of taxpayer money that were being used to deal with that situation. And at the very end, because Congress was getting repeatedly embarrassed by their own stupidity, from folks like Maxine Waters and that other idiot, I can't remember the other idiot's name, who all just kept singing the praises and saying how wonderful these programs are while they were costing all of us as taxpayers billions and billions of dollars. I think we ended up actually being close to a trillion. At some point, Congress gave up because they started looking like morons where every 4 to 6 months they had to pass a new bill to appropriate money to handle this. Ultimately, they said, for whatever amount it costs, for whatever amount of money this situation ends up costing, Congress authorizes those funds. And I guess how quickly people forget how horrible Fannie, Freddie, and to a great extent FHA were in this, in facilitating this and creating it. In fact, you can't even lay out the strategy that caused the problem in the first place without the participation of Fannie and Freddie. Securitizing those loans, that was all Fannie and Freddie. That was them getting together with banks and securitizing that stuff, which absolutely fed this problem. And don't fool yourself, that part of the equation is still around. Securitized loans are all still there. These government entities stepping in and buying these risky loans off of the lenders, off of the underwriters is still happening. All of the things, all the elements, it's now complete. The circle of stupidity is done. We are now doing all of the exact same things in slightly different ways that we did last time that caused this mouthful of sewage to come backing up on us. I'm just not jazzed. Now, just let's quote Representative Jeb Hensarling of Texas. Now, he's the chairman of the House Financial Services Committee, called the free reduction irresponsible. Quote, "It seems the Obama administration," and we don't even need to say this, I realize that there's folks who want to put on the red hat or the blue hat. Let's just keep in mind that this kind of crap has come from both colored hats. Whether you want to talk about George Bush going out and talking so wonderfully in 2004, 2005, 2006, and how proud he was at how many people had been put into homes and been able to buy a home and how financing had been extended to them and all these other wonderful things. Doesn't matter. There isn't we don't lay this one at the feet of a specific administration. You can get into some nitty gritty, but this was an act of stupid that goes back to 1994. Well, it goes back to 1972, but the first monumental act of stupidity in relation to that first stupidity was in 1994. Quote, "It seems the Obama administration's parting gift to hardworking taxpayers is to put them at greater risk of footing the bill for yet another bailout." And that's really the final the final element of all of this. At no part does this make sense, right? We talked about, are we really helping the person who's doing the borrowing? Are we really making the real estate market a better place by doing this? And finally, are we actually doing a responsible thing as it relates to budgetary decisions? And no, we're not. There is not one ray of sunshine in this whole celebration of stupidity. Yeah, it just hurts. Stupid should hurt. And there should be an awful lot of people in government right now with a horribly painful headache because there's nothing. You know what's funny? I'm okay with saying, you know what? Let's try a political experiment and do this and see what happens. All right. Maybe ahead of time you could have called it. Maybe if you'd read a little bit ahead of time, maybe a little von Mises, just read some good treatise on smart economic practices. But what's most interesting about this is lessons they've all learned firsthand. They were there. They had front row seats. A lot of them voted for this stuff, and somehow, this stuff makes sense to them. How did these folks get elected? It's as if there's an intelligence test that you have to pass to become a politician. But the only way to become a politician is passing the test means that you score the lowest. The only way you could become a politician is if you're the dumbest one. So there you go. It's my little editorial comment for the show. I find this stuff ridiculously frustrating. For those of you who have a different view, I'm very happy to entertain it. I feel like I have a pretty good handle on this, and I can't think of anything I've expressed here that totally falls outside of the realm of reality. Maybe this stuff will actually make sense in some marketplace where there's this really small number of buyers out to buy this really huge number of homes. I'm guessing that's a minority. We've got other stories we could cover in today's show that talk about all the metro areas that are seeing inventory challenges. And even some that aren't metro areas. The properties we covered yesterday would clearly probably be better choices, right? Where you go to Midland, Texas. That's apparently a hotbed for high inventory, low buyers. So maybe some folks in Midland might benefit from this. It seems to me, though, if anything bad does happen, Midland's going to be one of the first places to die on the vine, but who knows? Maybe I'm completely wrong. All right, folks, I have to think that at least today, I in some way repaid you for the expenditure of your time to listen to this show. I want you to keep this little nugget in your head, bounce it around, and when you hear someone at the water cooler at work or online at Starbucks talk about how wonderful it is that the FHA has finally dropped those pesky insurance premiums by 1/4 of a point, to help all those poor folks who want to become buyers, explain to them how they just helped nobody. There is nobody that they have helped, and explain it to them, because knowledge is power, I guess. But is it really power when you feel like you're the only person who knows it and everyone else just keeps doing the dumb thing and it just hurts your head every time you think about it? I don't know. Well, thank you for listening. I hope that you have a wonderful day, and I'll talk to you all next time.